What are market structures and how does that play any type of role in quantitative trading? That's the topic for today on episode 8 of the Independent Quant podcast. I'm Luis, the host and founder of the Independent Quant. Thank you so much for joining us. With that, let's dive right on in. As a reminder, I am not a financial advisor. I'm not here to give advice on what you should do. Any trade that you take is your own, and all of this is for educational purposes only. So with that, let's get started. So market structure, plays a big part in just trading for us. If you're a mutual fund person that just puts your money into a mutual fund and lets someone else trade your money for you, manage your money for you, you don't really have to worry too much about market structures. But as traders, quantitative, systematic, or algorithmic, market structures play a very important part to how we approach the market and how we execute our trades and how we go about our business, So what is market structure? Market structure deals with how assets are traded and priced and ultimately executed in the market. One example would be order types and execution methods. So the difference between a limit order and a market order. Limit orders being you're telling your broker, I want to be filled at this price or better, while a market order says whatever the market's trading at right now, that's what I want you to fill me on. So that is part of market structure. Who is in the market, be that if you're like in the S&P 500, that's everybody, right? That's big institutions, small traders, mutual funds, But in contrast, if you go into another futures market, let's say lean cattle, well, that's very thinly traded. You're probably only going to have people within that industry that are trading that. Same maybe with soybean, not as much. We do get a lot of institutional traders and a lot of small traders in there because it is something that's traded very liquidly, but it's not the S&P 500, right? It's trade at an order of magnitude less. And that's because of the players that are there. And that is may decrease the level of opportunities that you have when you trade in those markets because you're dealing with a lot of what is referred to as smart money. You're going up against strategies that are a little more challenging to go up against. Another one that I kind of touched on with that market participants is that liquidity. The more market participants and the greater order flow going through a market, the greater liquidity that you're going to have. And that's going to have effects on some other aspects of market structure that we're going to talk about here in a moment. But then market fragmentation is our last talk. A market is made, now the futures market's a little simpler, so that we're going to talk more on equities here. There can be multiple exchanges where your order can be routed through in order to get filled, right? In the futures market, we're a little spoiled. If you're trading ES, it's almost likely, it's pretty much guaranteed that it's going to go through the CME, the Chicago Mercantile Exchange. That's where ES is traded. That's not the case with everything. That every other instrument that you may be trading may have multiple exchanges, which will factor how you get filled. And this is where the opportunities for arbitrage come in for those that are a little more informed on that. We're not going to talk on arbitrage here. That's a very advanced topic and something that smaller traders like us aren't really doing. But market fragmentation is the last, kind of bit we need to understand it for market structure, right? Now, there's market structure as I just described it, but there's also a microstructure that we talk about as traders. And that microstructure includes bid and ask spreads and liquidity associated with those bid and ask spreads. Now, what's a bid and ask spread? So this is deceptive. When you look at a chart, you can set them up any which way, but they may be giving you the last price that the instrument you're looking at traded at. Or it may be showing you the market price where transactions are happening. Now, there's more going on in the market. When we send our orders in, we're either bidding or asking, and you get the worst of the two. So if you're selling, you're going to get the bid. If you're buying, you're going to get the ask. And there's a difference between those two. It's a spread. So not everybody that's trying to sell Apple at $3.20. That's obviously not the price for Apple. That would be great if it would, but it's not. That's the number I chose for right now. If Apple was $3.20, that could mean if I'm trying to sell it at $3.20, but somebody's trying to buy it at $3.15, there's a 5-cent spread, right? In order for that transaction to happen, broker would take that spread. And that's why some markets don't have a commission. For example, Forex is very popular to not have commissions or fees because the broker is taking the spread. Now, the spread is going to be dictated a lot by the liquidity that's available in that market. If there's a lot of traders trading that symbol, then it's going to make those spreads that much tighter. If it's a loosely traded instrument, then those spreads start widening up. If you're an options trader, we live and die by spreads. I mean, that's my primary trading tool. I started on futures, but today I trade options. Well, I've been trading options for several years now, but that is something that we take into account in every trade, because when we buy or sell an option, we are down the spread. We have to recover that. It factors into our analysis as to how we transact, and the spread becomes kind of inconsequential if you're trading options on the S&P 500, but it wouldn't be if you're trading, again, something that's illiquid. There's a way to capitalize on that. There's a way to make sure you don't lose any more than you should when you're trading a market. So that's where microstructure and the bid-ask spread factors in. Another factor for market microstructure is order book dynamics. So the order book is where the actual transactions are taking place. So we have buyers sending in orders for where they want to buy, and you have sellers sending in orders for where they want to sell. Naturally, there's going to be multiple sellers and multiple buyers at each price point. Order book is going to tell us how many are transacting at each one of those price points, because not everybody's going to be serviced, right? There's, because of the spreads and because of how big orders people are putting in compared to how many people are on the other side, that's going to dictate how many transactions are going to be able to be filled at any one price point. The order book informs where those missing orders could be, where the interest in the market for it to be. Discretionary traders see this as an opportunity for gauging support and resistance. We can do that too, as well as quantitative traders. Systematic traders can do that too. If they're using a support and resistance technical analysis approach, it's a good way to gauge where the market could go and really where it couldn't go, because you can see what's happening with the order book. So that's a key factor in market microstructure. Now, the last one within microstructure here is going to be slippage. So slippage is a factor usually when you're placing market orders. There's limit orders. Slippage is usually in your favor. It should be in your favor because it should be the price that you're got the order in or better. But slippage can be an adverse factor in market orders. What slippage is I said I want to buy right now, and your intent was to buy that apple at $3.18, but you get filled at $3.27. Now you've got that's 9 cents of undesirable price action, right? That just came your way. That is slippage. That is getting that undesirable. Well, slippage can go the other way too. You could have gotten filled at $3.11. You wouldn't complain about that, but it's still the same issue. You're not getting the price that you desired, and that's something that we have to factor in a market microstructure. If you're trading something that's very liquid, very fluid, then slippage isn't as much a factor. It's just the same thing as the bid-ask spread. They're very much related. If there's a lot of activity, there's a good chance you could get filled at the prices you desired. But if you're trading something that's thinly traded, slippage can quickly become a factor. All right, so now we're going to talk about market structure and its influence on us as traders. So trend following, and let's take that as a start. It really works well for markets that are trending, hence the name, trend strategies, right? If a market is going sideways, it is not the ideal time to be in that market. But if you're looking for a trend following strategy, you're usually going to be looking for those that do present those directional movements and that are liquid. In the equity markets, they do show stocks show some momentum. Those are the ones that you're going to favor. In the futures markets, we usually find this in the tangible products. And I mean that by just be that the ags, the softs. I'm not going to use futures language because many of you may be newer. But so there's agricultural products that are traded in futures, like sugar and coffee. Soybean is a big one that I mentioned earlier. There's actual farm animals that are traded. This I've never touched, but there's lean cattle. There's a hog. There has a name for it. Those products tend to have a trend to them because they are, especially the stuff that grows out of the ground, has a seasonality to it. It's you plant something in the early spring and you reap it in the summer, whatever it is. There's a cycle to those. So they usually have a trend to them. You can exploit that and you can say, okay, well, because that's what the market structure is like for that and how liquid it may be or not, you can determine if a trend following strategy is advisable for you to trade there. In contrast, if you had a mean reversion strategy, liquidity is always an important factor for us as traders. I personally don't know any trading strategy or have ever met a trader that trades thin markets because they're thin markets. If I've ever come across anyone that's traded something that's not traded much, is probably because they have some knowledge of that industry or that product that they can assess what is happening and how to trade that market. As an example, like the live animals that I was mentioning, I've never traded those and I've completely stayed away from them because they are very gappy. Like they jump price so much. If you're in that world, you'd understand why. I'm not in that world, so I don't understand why. So implementing a mean reversion strategy on something like that, beyond my reach, right? Like I'm not trained to that. But if you have a highly liquid market where you can see that clear price movement, the fills are acceptable. Slippage is minimal. The bid-ask spreads are tight, and you can see that it really is not a trending market, but it does every time it goes to an extreme come back to its mean. Hey, that's a way to now exploit that market and make some money off of it. And this last one I mentioned just for thoroughness, but I'm really not an expert to talk on this, which is arbitrage strategy. That's taking advantage of those fragmented markets that I mentioned earlier. That's where you're buying a security in one market because so you have, let's say, a symbol. It's traded in multiple exchanges. Let's say there's two exchanges. Reduce it down to those two exchanges. In one exchange, transacting at $3.15. In the other exchange, exchanging at $3.20. You can buy it at $3.15 at that first exchange and then sell it for $3.20 in that second exchange. The problem with this, and why I say that this is kind of beyond the reach of myself, is it takes very powerful computers and a very expensive infrastructure to make this happen, because those price discrepancies exist for microseconds. So typically it's very large money that's dealing with these arbitrage, but it comes from that fragmented market idea that I just described earlier with the market structure. So how can now we as algorithmic traders make use of everything that I just talked about? Well, for one, we can make algorithmic execution and that adapts to the market, right? We can use indicators like a VWAP or things that are indicators that are looking at the market right here, right now, and bouncing that off some other indicators to assess, do we enter here or not? Now, if you're not using indicators because you're not much of a technical analysis, but you're using maybe some type of statistical analysis for that, then same idea. You're exploiting the market structure and the microstructure algorithmically, and the algorithm is making the decision for you as to whether or not that's followed and meets the rules that you've set and transacts for you. The next step with that is you can actually implement machine learning on your strategy and look at the market structure and the microstructure to make more informed decisions and make the algorithm smarter as it goes along, which gives you some survivability if there's a regime change, because they may not be abrupt. They may happen gradually, which the machine learning model that you've developed might be able to adjust and keep up with it. So that's another way that we can exploit that. Now, this last one, I also say for thoroughness and completeness, I am not an expert on this one as well. I'm informed, but that last one is high frequency trading. That is trading hundreds, thousands of times a second. Again, this is done more by larger firms or people with a lot more money. It takes a lot of infrastructure, But what's happening there is the same. They are looking for those inefficiencies or exploiting an edge that is existing at the microstructure level of the market. That constitutes like a lot of what the market structure is and how that's important for us as traders. If that sounds really appealing to you, then go ahead. I invite you to sign up for our newsletter. Head on over to theindependentquant.com. Keep informed with everything that's happening with us. Get smarter and better at your trading. And I look forward to seeing you in the next episode. Keep it green, everyone.